know investors who've made an absolute killing, and we're often reading in the media how if only we buy this or that asset or investment product, we could make one as well. There are even financial advisors who give the impression that investing is a one-way bet. But the first lesson to learn from market history is to be realistic.
The history is very, very strong. Long-term. Short-term treasuries return the money after inflation, but that's it. You return of the money, but no return on the money. Bonds do a little bit better, and stocks do better than that.
One problem is that we've lived through an era of unusually high returns. In the second half of the 20th century, equities have performed far better than the historical average. Since 1980, bonds have had an exceptional run. And property in most parts of the world has also boomed. In short, we've been spoilt, and we've come to expect returns that are unrealistic.
The phrase that comes back over and over again is this notion of overconfidence. There is a mountain of literature from the psychological field explaining that people, for whatever reason, exhibit this persistent behavioral characteristic.
When it comes to risk, we're often over-optimistic as human beings. We think that we're willing to take more risk than we actually are. So I think it might be a good idea to really review your past behaviours and see not only the good things that have happened and the gains, but remember the losses as well.
Humans are also very social animals. We like to do what others are doing. When we see people making money, we want to pile in too. And that ultimately is what makes markets unstable.
What return do we expect when markets are going through a period of investor enthusiasm? Well, risks seem low, and so we don't require a very large return. And what growth rates are we expecting? We're expecting very large growth rates, and that's quite fragile. So the more confident people feel about the future, the more a tiny nudge in perceived risk or a tiny nudge in prospective growth rates can seriously knock the market down.
And that's exactly what happened in 1846. Behind me is Curzon Street Station in Birmingham. It opened in 1838 at the start of a boom period for the British railway industry. Everyone wanted shares in the newly formed railway companies. After all, railways were the future.
People started seeing the prices going up and wanting to buy, and ordinary individuals such as the Brontes actually speculated in railway shares. People started making a lot of money, and prices eventually fell because there wasn't enough traffic to support all these railway companies.
Of course, railways did become very popular. In just the same way, technology has become a major part of people's lives, despite the bursting of the dot-com bubble. But both episodes show how easy it is for so many investors to lose their sense of perspective.
Almost certainly it will happen again, whether this is the investment community selling stocks or whether it's media commenting on the markets, and this whole idea of new era thinking will re-emerge. When that will happen, I don't know, but I will guarantee you that it will happen.
Of course, being realistic is one thing, but if all this talk about bubbles and crashes is putting you off investing altogether, that's certainly not our intention. We'll explain why in part 3.